Should you be buying gold if you have debt? It's a big question, one that would be ultra relevant to some and just moderately interesting to others. So we're going to try to cover that, but we're going to add in another angle because I think we can do a lot better than moderately interesting. So I think we need to open this one up with some quick backstory. We've made a bunch of videos saying the Fed rate policy pivot was going to be a big deal. Now that proved itself to be true. Kind of proved to be a big deal before it even happened. And we also made a few videos saying that if we saw a 25-point cut on anticipation of a 50 basis point cut, we might actually see a little bit of a dip. And that'd be because we were already riding that big deal curve, at least to some extent. And then on Wednesday, we made a video saying the pivot's here. Let it rip, because the Fed went big with the 50 basis point cut, and I mentioned, hey, we're going to expect a little bit of volatility, but at this point, we really get to see what gold price can do. Now that backstory is important because throughout all of this, we've had people saying gold is too expensive to buy. So let's get a chart here showing what this period of time looked like for gold. We started 2024 with gold at $2,045. I think most people expected some kind of price retracement prior to the Fed decision, but look, by February, it was pretty clear we weren't going to get it. Now, this year alone, we've seen a 28% climb in gold price, but a common sentiment has been that, hey, I'm holding back for a pullback. And I'm not throwing any shade here. We're going to get into that in a minute, but another flavor of comment has been that I'm actually encouraging buying when maybe we should be waiting. And I don't want to give too much attention to one type of comment, but it comes up and I just say that, hey, I put this channel together to give people information to make their own decisions. I show what I'm doing to make it a little bit clearer how to get into it, even give some information on what I found along the way, good and bad. Maybe you can learn from my mistakes. Maybe you can see what's worked for me, but I don't encourage anything beyond the idea that I think everyone should at least consider a non-zero position in gold. Beyond that, though, we're just here talking about a common interest. So before we get into the topic, let me give a quick thanks to channel sponsor Summit Metals. I've told you a little bit about them already, but they're a gold and silver dealer that Bald Guy Money and I have been able to work with to dial in on what we think you all need and want most. And that's all you're going to find there. That's low prices, fast shipping, and no real mystery or distractions beyond that. So check them out, summitmetals.com. About an hour after posting Wednesday's Let It Rip video, spot price actually pulled back from a quick run to $2,600. Now, it didn't go negative. It just traced back to the pre-announcement price. That's what was happening right in this period of time. Now, no surprise, of course, we're going to see a lot of trading in the 24 hours after an announcement like that. Normally, I would wait to post anything, but we knew a 50-point rate cut was a big deal, and it was going to send the price of gold up, whether it took 2 hours or 24. But there were enough comments saying we shouldn't be buying, and even a few saying that I shouldn't be encouraging it, that I thought we need to step back and take a look what gold is really for. How buying over time is different than trading, because this channel is definitely not about trading rips and dips. Sorry, folks. So look, there are a few alternatives to buying gold that maybe we should look at. One, hey, it'd be saving cash, pretty basic. Any gains gold makes beyond the initial purchase premium, or maybe we should say the buy to sell spread on that premium, beats cash. And that one is pretty easy. Another would be investing. That's maybe a little too broad to get into real deep, but we can show some indices as a comparison. And then another one that I think is actually pretty interesting would be paying off a home mortgage. Now, some of you have already paid off your mortgage, but bear with me because this topic is interesting and relevant here in the charts. They're going to show everything I just mentioned. So this question of paying off debt before buying metals comes up a fair amount. Now, personally, I was buying metals and I was investing long before I had a mortgage paid off. That just will give you a little bit of personal context on me. If you think that's a bad idea, well, everything that I'm about to say is going to be coming from somebody who did that bad thing. So just to be clear, though, I was never buying gold using credit cards, stacking up high revolving debt. And I think we can all agree here there are different kinds of debt. And if we want to put them into simple categories, maybe we could just say high interest revolving debt and low fixed interest debt. Now, we're going to assume that the low fixed interest debt would be for something like a mortgage and would probably be big enough that we couldn't just quickly pay it off. So we're going to compare the returns on gold, silver, the S&P 500, and the Dow Jones just to see if those returns would outweigh the interest against any debt that you're servicing. Now again, We aren't trying to answer the question of what you should do in this situation. We're just looking for the data. So maybe you're a few years into a conventional 30-year mortgage, 3% interest. That would be low. Should you pay that off before you invest? Well, if we polled 10 people, we'd probably get 12 answers because there's no single right answer. So we're just going to get into the charts and see exactly how gold, silver, the S&P 500, and the Dow Jones indices would compare to some kind of home mortgage interest burden. So this chart shows the past 12 months. We're going to start with an easy one because this has been the point people have been suggesting that maybe we should be sitting out of the gold purchasing. So if we said our mortgage was 6% or lower, where would we fall here? Well, we can see that all four asset classes would have outperformed that 6% amount by a lot. Gold tops the list at 34%, silver's at 31%, S&P 500's at 25%, and the Dow Jones is right around 20%. Now, this chart is a few days outdated, but what's a positive percentage point between friends? So just speaking on the math, not on the complexities of a 30-year amortization table, we would have been better off putting our hypothetical money to any one of those four asset classes. That's rather than making additional payments on a mortgage with a rate lower than 6%, or in this case, with the rate lower than 20%. Does that mean that's what you should have done, or that I'm telling you that that's what you should do? No, I mean, you're going to have to add up all your factors and decide for yourself. That emotional stress of having a mortgage, that might make you want to pay it off as soon as possible. Maybe life would be better for you if you paid your house off earlier. But the math is clear. If a mortgage costs you 6% or 3% or whatever your mortgage is, and the return on an asset is 20% or 34%, you're better off from an accounting perspective putting your discretionary money toward the higher performing asset. Now, the rub, of course, is that there's just no way to know the future performance of an asset. So if we widen the time frame a little bit, we get a better look at recent performance, and we can see that over the past 4 years here, now gold has gone up 39%. Silver is up 29%, S&P is up 69%, and the Dow is up 51%. That's without dividends. So that would tell us enough to respond to an internet hero dropping into the comments telling us it doesn't make any sense to buy gold if you have debt. I think that's a generalization we just proved wrong. The real math gets far more complicated than we want to get into here. Each of the assets shown have appreciated at various levels throughout the time frame. Of course, if we add in compounding appreciation, it's going to get even more complicated. But the 4-year time frame at least gives us a number that we could average out for the sake of debate. And for what it's worth, I'm not cherry picking timeframes here. Gold was trading at an all-time high in September of 2024. That's what I was basing this off. If I would have just used 2 years, well, gold and silver appreciation would look even better. But even at 4 years, we're comparing 6% and lower to 29% and higher. That's using silver as our lagging asset. So let's get some silver in the frame, and why not use a 2,200-year-old Athenian tetradrachm to do it? And I'm looking forward to people telling me you should never handle your silver. But again, it would be 39% if we're looking at gold. Either one, though, silver or gold, both beat that 6% mortgage rate by a long shot. And hey, look, I now have my favorite silver coin of all time sitting next to my favorite gold coin of all time. So let's slow this down with a new look at the chart, because somebody out here is smarter than me. They're either doing the math or they're looking for holes in the logic. And it isn't hard to find a unique case where none of this seems to work, because if you bought gold in September of 2020 and then you sold it, say, September of 2022, well, gold would have been down 11%, silver would have been down 18%. I mean, I pity the fool who would have bought gold on a high and sold on a low like that, but I guess it's possible. Now, this is never about timing a trade. Sure, that would have been a case where we wouldn't have beat 3% or 6% interest savings by paying ahead on a mortgage instead. But between us, using worst case scenario snapshots in time like that is just kind of a small brain tactic, one that we can probably ignore. The average annual return for gold over the last 5 years is 11.8%. 8.8% over the past 10 years, 10.1% over the past 20. So without saying whether or not you should do this, buy gold rather than pay off a mortgage early, we can at least throw out the suggestion that you shouldn't. The math doesn't back it up. So real talk here, the only people who advise you to pay off your mortgage before doing anything else are probably people who've paid off their own mortgages. They feel pretty good about it, and maybe they'd like you to know they've done it too. But it isn't the kind of advice that travels. The vast majority of people save and invest long before they have their mortgage paid off. It's just a silly debate. Now, the interesting part in all of this is simply how saving with gold compares to the returns of other assets or the burden of non-principal payments on loans. In most cases, we can see the performance in terms of gains is well ahead of a loss to non-principal interest. Again, that doesn't tell you what to do, it just gives you the facts. Now, the big brains in the room already know this is not an either-or question. You can do both. You don't have to pay down a mortgage and delay everything else for decades while you do, without letting it be a gating factor to anything else. We've even shown there are logical reasons not to, and we have the charts to back it up. So let's call it good there. Let us know what you think about saving and investing while you're servicing debt. Now, I know there are a few of you out there who are hardline against this, but I don't know if there are any of you out there on that side of the debate who still have a mortgage. Let us know. And while you're in the comments, be sure to hit that like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you want to hear more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.